I want to welcome you to our second training webinar, Warranty and Service Contract Financials 101. Before we begin, I'd like to remind those of you who are attending today that the third in our series of training webinars is scheduled for August the 19th at 1 Eastern. The topic will be unifying and simplifying the service experience, and this will be led by Mark Fears from Mize. Watch your email for updates. Also like to remind you that this session will be recorded and will be linked to the GWSCA website if colleagues who were unable to make it today would like to hear the webinar in the future. We will also be presenting all three of our training webinars live and in person at our second annual conference on warranty and service contracts to be held September the 16th through the 18th at the Palmer House Hilton in Chicago. For details on that conference, please check our website at gwsca.org. We're extremely fortunate today to have two experts joining us to discuss warranty and service contract financials. First is Michael Paczolt. Mike is an actuary in the Chicago practice of Milliman. Mike's area of expertise is property and casualty insurance, including loss reserving and rate making. Mike has experience in commercial lines, including workers' compensation, professional liability, general liability, auto liability, and both manufacturer and extended warranty or service contracts. He is a regular speaker at industry conferences and has published several papers on the topic of warranties. His experience includes working with insurance companies, self-insured, and captive insurance clients. Mike is joined by William Eliason. William is the Global Warranty and Finance Controller for Oracle. As the Global Controller for Oracle, he manages Oracle's Global Warranty Reserve. This includes oversight of consolidating warranty and service contract support financial metrics, which Oracle uses for forecasting associated with new product offerings, customer quotes, and service product margin reporting. William holds a Bachelor of Science degree in Business Administration from Bellevue University, an MBA from the University of Iowa, and he is a member of the AICPA. This time I'm going to turn it over to William. William?
Yes, thank you, Terry. I'm going to advance the slides now, excuse me. Okay, here we go. Great. Well, welcome everyone. I appreciate everyone attending. Today we are going to speak about warranty finance, basically, and also defining, all the attributes of warranty finance and warranty and service contracts, because those terms have been kind of interchangeably thrown about, and they are two very different contracts, warranty or transactions, warranty versus extended warranty. First, we'll cover warranty finance. So what we'd like to talk about today, the objective of the session, or the webinar, is to identify the elements of warranty finance, as I said, and describe the differences between warranty and extended warranty, because those are, in fact, two different transactions, markedly different, and their accounting is different, and their reporting, financial reporting is different. Also, we'd like to talk today about a loss triangle that is used in selling service contracts and third-party service contracts, and so that's an extensive area in its own right. We'd also like to talk about FASB, Financial Accounting Standards Board, and their pronouncements and statements regarding warranty, how it should be accounted for, how the estimate should be developed, etc. And then we want to talk about some of the major financial terms that go with warranty finance, which are accruals, where we're trying to record our expenses, and the liability, which we are documenting in our external reporting. If you have a public company that you're working for, and the 10K, which is the yearly financial report to the SEC, or the 10Q, the quarterly, if your warranty liability is pretty significant in association with your products, you will have to report that as a separate exhibit on your financial statement. So we just kind of like to cover some of the things around that. Okay, so why are we here today? What's the value of warranty finance? Why is it important? Why do we care? And obviously, there are a lot of happy byproducts that we get from warranty finance. The fact that we have to identify what the liability looks like for selling products we offer warranties on, our companies do. What's the likelihood it's going to happen? And if it does happen, how much is it going to cost, or how extensive is it going to be financially for the company? And so with identifying that, we learn a lot of things about our products. The quality of the products. Do we have issues with quality that we need to pass back to engineering so they can design those out of the product? And also the cost of those. Also serviceability. How easy is it to service our products? What does it cost if a service event occurs? And so this is all valuable information associated with warranty finance that can be passed back to engineering and the hardware support organizations. Also, it can be used in the contract deal analysis and pricing, so that as you're developing what's the right price to price my product at, you can do it efficiently so that you're not overpricing it, and you can still make a fair margin and be profitable on the offering. And so it's kind of to optimize that and be efficient and take that waste out of the business. And again, as I stated previously, so it's for new product offerings. This information, this warranty financial information, can be used in that. Also in vendor warranty costs. In the auto industry, OEMs, or original equipment manufacturers, are used extensively in providing warranty support on products. And so there's a significant amount of cost associated with that. And so that information also could be passed back to the OEM so they can design potentially costly failures out of their products, and also help the primary manufacturer get the best deal and put out the best product without inefficiencies in it. Okay, so then moving on to FASB. And what does FASB have to say, the Financial Accounting Standards Board and International Accounting Standards Board, regarding warranty? And recently there was a new pronouncement that came out in the last 4 years that was kind of significant. FASB is trying to standardize revenue recognition for products so that when analysts are reviewing companies' 10Ks, 10Qs, they don't necessarily have to be subject matter experts in a particular area to be able to fairly evaluate their revenue reporting. And so with that comes warranty, because warranty is part of the product cost and associated with product revenues. So through this new pronouncement, it was decided that there had been two schools of thought on how to account for warranty. Should it be set aside as a revenue and recognized ratably over the life of that warranty contract or that agreement, or should it be accrued for and expensed with the product cost at the point of sale and the revenue fully recognized at the point of sale? And so this was getting more and more complicated, so FASB decided to clarify and issued a statement kind of defining the two transactions. So it was determined that if the customer has an option to purchase the warranty, then that to some extent is a support contract or an extended warranty. So that's a separate transaction from when warranty is offered with the product. So for instance, if you're you're just buying the product, and by the way, it comes with a 1-year warranty, but you're not really purchasing that separately or paying anything above and beyond the cost of the price of the product, then that's a different transaction than if you have the option to purchase the warranty separately. Then it becomes a service contract or an extended warranty, and that would be not accrued for. It would be amortized over the life of the contract. And so then, as I said, number two, if the customer doesn't have the option, then it should be accrued for that estimated cost of what that failure, should it happen, it should be accrued for at the point of sale, and then 100% of the revenue would be recognized on the transaction at the point of sale. So again, on the first one, it would be deferred. That section that was the warranty contract or the value of the warranty would be deferred over the life of the agreement. Second one, no, it would be accrued for as a cost, and 100% of the revenue would be recognized. And then they went on to further define how to estimate that and provided a little more clarity in this area, which in the past had been somewhat vague. And so, you know, as after this, I can certainly provide the links to their website so that you can read up if you're interested and get some more information on estimating warranty. So again, this has to be, warranty has to be accrued for and reported on the financial statements, as I said. It has to be, also there has to be some information in the 10K and 10Q on how warranty was estimated. So, you know, there'll be some verbiage on how they actually came up with the estimates for warranty. And then there has to be a tablature of reconciliation of how, with the beginning balance, what's in and out of the account, and then the ending balance. And I'll go through that here pretty quickly. So again, the companies need to state what their total warranty liability is, what they've added to the account as they've sold product and their liability grows, and then if they're paying or making payments to on claims, either to providers or directly to customers, they have to subtract those out, and then, you know, again, we get a overall ending balance. As we've said here, let's see, I think I can go through. Here's what the table looks like. So we have our opening balance of the warranty reserve, or what we intend to pay out in the future for possible claims based on sales. We have net accruals made, and they're usually accrued maybe based on just purely on hardware sales, on sales or a product, or shipments of product. They can be accrued by shipment. And then we want to subtract out any claims that we've paid, either to service providers that are third party, maybe directly to customers, maybe to your own people if they are working on the warranty. And then any residual money that hasn't been spent that is associated with the warranty that the term has ran out, then those would be released too, and that money would be taken off the books. It wouldn't be a liability. Any changes in estimate, so say for instance you had some product that you've accrued for in the past and you find out that it is either more expensive or less expensive to service that product under warranty, then adjustments can be made in total to the amounts to raise or lower them to reflect that. And then also we have FX impacts. And so if your company, say you're based in the U.S. and you have extensive operations or significant parts of your business that are done in EMEA, APAC, Latin America, etc., when you report your liability on the financial statements, you know, you can adjust that to U.S. currency. So you have to account for fluctuations, as we've seen recently with the euro changing significantly in relation to the U.S. dollar. That could have a big impact on your warranty reserve. So you want to make sure that's reported correctly. And then you have your closing balance. So then, again, as I said before, the international aspect is the fact that if you are a larger company but you're still U.S. based, you may have where you're reporting income statements for regions, you know, the North America, Latin America, as I said, EMEA, APAC, and you would actually have a PL or income statement for those individual regions. So you'd have to make sure that those warranty costs in those regions are appropriately accounted for and stated in local currency and then rolled up to USD if you're in the United States. So it's important to know where the product actually is based at, where it was sold, where it's going to be put into service at. So again, in reviewing, you know, we just covered some basics on, you know, how to basically formulate, and we'll get a little more into as we go on here into detail into how you would estimate that liability, maybe to product level. And, you know, the FASB That has to be reported if it's material on your financial statements as a separate exhibit, especially if you are a public company. And this has to be reported to the SEC, Securities and Exchange Commission. So then, yeah, we have a quiz. I don't know that we're set up to actually have you speak back, but if you're looking through this list and you would say, what doesn't belong here? And then proceeding, we would find, oh, net failure rate. Now that doesn't belong because we're looking at the opening balance, any accruals we've added, any payments we've taken out, any changes in maybe the original estimates, foreign currency, and then that's our closing balance. Okay, so yeah, then as I said, if we wanted to get more into how would we formulate this accrual? You know, if I know I have product sales, but how do I figure out what I should account for as I sell product? So obviously you're looking at, you know, the number of units you're selling. Your cost per unit would be based on your failure rate. We obviously wouldn't want to assume that every product is failing because they all don't, but there's some percentage of products that do fail, multiplied by what that cost per unit would be if it does fail. And then we would come up with what we should be accruing for every product that's sold, you know, keeping in mind that not every product will fail. And then again, we might have historical data which helps us adjust that estimate up or down. So periodically, if you had some system that you could check what it's actually costing per unit on the average, then you could adjust those estimates up or down. And as you get new products, they're going to be different than older ones. So you're going to need initially to estimate some of those, and then you will adjust once you get actual data. And so again, you know, we're accruing based on sales, shipment, manufacture, some kind of volume-based metric to accrue. And then obviously your liability out there on the balance sheet is defined as, you know, what you think you're going to have to pay in the future as those products fail, how much money, how extensive that's going to be. And so again, it can be as high level or as detailed. If it's a huge balance, like some company like Hewlett-Packard that has some $2 billion out there at any given time for their warranty liability, I'm assuming they do it in detail. But if you're a smaller company, it probably can be, you know, a back of the envelope type calculation. But obviously, it's important because it can be a lot of money and can be very material to the financials. So there should be some type of rigor around the process. And then this is just something that applies both to warranty and to service contracts. And this is the engineering bathtub curve, and it kind of reliability curve kind of falls in with a lot of products that are electronically based, computers or consumer electronics, et cetera, have this same type of behavior that's been shown pretty widely across most industries, how the product performs over its life cycle. So initially, as the product is first bought to the customer, shipped out, there are more likely to be more failures when it's put into service, plugged in, powered up, et cetera. And there could be issues where maybe it wasn't installed correctly, maybe it was damaged in shipment, you know, things like that happen. That's going to increase the failure rates at the beginning, while it's likely in its warranty period. Then once it gets past its warranty period and things kind of smooth out and the customer's using it, has found out how they want to use it and it's working for them, maybe even it's been relegated to lesser duties than it was originally, and it's kind of stuck off in the corner somewhere. It's still working, but it's not doing everything it was. But then towards the end of its life, obviously parts are going to start failing and issues are going to happen. And this is real important for, obviously, if you're selling service contracts on your products, as you know, maybe they're way out of their warranty period, but you still have it under contract to the customer, and the product is starting to age, your costs can go up exponentially on that. So that's something you really have to take into consideration in pricing contracts and considering how you're handling your contracts with customers on older product. And maybe some incentive to migrate them into newer product or incent them to buy newer product. And again, you know, we talked about things that might affect claim rates. Obviously, we saw the bathtub curve, but there are other things, customer awareness throughout the warranty life. As the customer gets more familiar with the product, obviously, they're going to decide how they think it should or should not operate. And so that can generate claims if the product is not conforming to that. The length of warranty, as warranties get extended, maybe companies are trying to incent customers to buy their products, so they offer a longer warranty. You know, we saw some of the car companies went exponentially longer than what had been done in the past. That's obviously going to cause some issues because there's much more time for things to fail or wear out. So that's going to arise in claims, and then you know, just aging of products also through their life cycle.
You know, I think one of the misconceptions that people have about warranties is, you know, this concept of a failure rate. A lot of people look, you know, at really the claims that are coming in and assume that that's the actual failure rate of the product. When in actuality, you know, there's a lot of other factors that impact the claims that actually come in. So as you guys probably know, I'm sure a lot of you, you know, are already, you know, versed in warranty claims, but a lot of times there's no fault found claims, you know, where the unit comes back in and, you know, you, the manufacturer or whoever you may be in the chain, you know, you'll go ahead and just replace it for the customer, keep the customer happy. But in actuality, there was really no true failure there. It was, you know, really just, you know, it happens all kinds of ridiculous. I mean, the old call center example is, you know, the most popular failure is that the thing's not plugged in. So, you know, that's one thing absolutely to keep in mind. And there's a bunch of different factors that influence the actual claims that come in outside beyond just true product failure. So, what we'll go through here is some of the techniques that you know, a typical actuary would use to determine really the shape of this bathtub curve that William was talking about. And you know, we'll go through exactly how we come to this pattern. All right, let's see if we can go. All right. So the first thing that you do anytime you want to do an analysis on the warranty data is to organize the claims and sales data. Typically, that'll be done by sales quarter. If you're a manufacturer and you don't know when the product's actually sold, sometimes we'll do this on a manufacturer basis. This should tie back to how you're accruing, if you're accruing for products that have been manufactured or products that have been sold or whatever it may be. Oh, I'm sorry, my presentation here is showing the wrong slide in the wrong part. Let me see if I can fix this here. Sorry about that. All right, sorry about that. All right, so going back here, so we'll organize our data. So the claims would be the warranty claims data. How far back you go really depends on how long your warranty is. So if you have, you know, a 1 or 2 year warranty, you really don't need to go back more than really 5 years. But you know, I've seen some warranties that are even 30 years. So, you know, if you have a 30-year warranty, ultimately you would like 30 years worth of data so you can really see how, you know, the claims came in over the entire life of the warranty itself. And essentially what you're doing there is looking at how the claims develop over time. You'll apply that to more recent products that are only, say, a year into a 5-year warranty to see how those claims would develop in the future. And that can give you some projections, some predictions on what that vintage of product is going to perform like in the future. But we'll go through all this in a little bit more detail here. Kind of very foundationally, it's your costs are really based on two elements. One would be the frequency. So that's really your number of calls or claims per product. So if that's 1%, 5%, 10%, that would be your frequency. And then your severity would be your cost per call or per claim, I guess, depending on what metric you use. And so then your overall costs are really that frequency times severity. That would be your expected cost per unit. So if you had a frequency of 10% and an average severity of $100, then your expected cost per unit would be $10. And we'll get into how that ties into the accrual part. So in terms of costs that you want to include, you definitely want to include, obviously, your parts, labor, and travel, any other components of the cost. Some people will include overhead. If you can estimate, the overhead of the call center, management salaries, and things like this. Honestly, it's been, from my perspective, it's kind of inconsistent from company to company in terms of how they view overhead and whether that should be included in any type of liability estimate. I think on the one hand, you'd argue that, well, you'd have to pay for overhead if your company shut its doors and needed to run off that, any future warranties. But then I think, there's counter arguments to that as well. So, just something to kind of be aware of that, there is that potential exposure out there. So let's start to get into loss triangles. And what we're trying to do with loss triangles is really to find out the shape of that bathtub curve of how the claims will emerge over the life of the warranty or life of the service contract. And so essentially what we're doing is looking at a cohort of products or a vintage of products for a specific year and seeing how the claims develop over time. So we'll just go through a very simple example here just to get you guys familiar with what a loss triangle is. So, in this example, we'll say, let's go back to the end of 2005 and say, okay, let's look at all of the products or contracts that were sold in 2005 and what was the total cost at the end of the year. So in this case, it was $100,000. If we were to step ahead a year, we would see that $100,000 actually grew to $200,000. So this is a multi-year warranty example that we're looking at here. So for those specific products sold in 2005, at the end of 2006, you've paid $200,000. As we continue to go on and add on successive years as we move into the future, you can see that something that began as $100,000 ultimately grew to $388,000. So essentially what we're doing here is looking at how this specific vintage product developed over time. So if we go ahead and move to the next slide, we can add on the other future years. So in this case, we're looking at a snapshot at the end of 2011. So you can see for the 2011 year, we only have data really for 1 year, right? Because we're only at the end of 2011. We won't know what happens in the future until 2012, 13, 14, 15, 16, etc. But what we can do is look at how claims developed historically in historical years. So essentially what we would do is look at the development pattern that we see here and apply that same pattern to these newer years. So essentially what we'd be doing is bringing these current costs to ultimate for that specific year. So essentially what we're doing is taking this loss triangle and making it into a square. I've kind of mentioned this here. So, in terms of how this works, flipping back to the triangle here, you can kind of see from 12 to 24, the value about doubles. From 24 to 36, it doesn't quite double. It probably goes up by, let's just say 50% to make things simple. So essentially what we're doing is we calculate what we call loss development factors and develop these amounts to ultimate. let's keep going here. So how does this all tie into a liability? So once we complete the triangle that we saw here, so we'd ultimately have values here in the last column. That would be what's going to be paid on those products at the end of time, essentially. And our liability is really what we expect to be paid at ultimate less what's currently been paid. And the difference between those two would be what the outstanding liability is. So these would be the future payments on any product that's been sold. So you can see for the 2005 sales year, all that product is already out of warranty. So you can see it as a liability of 0. But for 2011, that product has only been in warranty for 1 year. So there's, a majority of the liability would be for that 2011 year. So you'd sum across all these sales years to get to a total liability of $755,000. In terms of the accrual, the accrual is really what you expect to pay on any units that would be sold. And so here what we do is we would use that information we glean from the liability aspect here. We would calculate, we pull that estimated ultimate, which is the same thing from the prior slide. We'd look at the number of units that were sold, because obviously if volume goes up or down, we would also expect our ultimate cost to go up or down. And then we adjust it for any trends that we saw in the data. I left it 1 here just for simplicity so you guys can see the math, but a lot of times we'll use something like inflation, or if you would expect costs to go up or down for some other reason. For instance, if your materials increased, some resource that you use changes, or gas price changes, so travel costs have gone up, things like that you would adjust for. And so what that's doing in this last column is essentially making each one of these historical years what we call on level with 2012, which would be our projection period. And we have these rates, and we can essentially select an average from these rates to be our quasi-projection for 2012. So, when we do this, we typically look at multiple years worth of historical experience, because there will be randomness from year to year. Obviously, the more recent years are more recent, so it's probably a slightly better estimate. So some people will just use the 2011 rate for 2012. We don't usually do that. We'll usually look at the last 3 or 4 years and do an average of those, just because there is randomness every once in a while from year to year. And that definitely depends also on the volume of claims that you're getting in. If you're getting millions of claims per year, if you're an HP, then probably the last year is kind of credible enough to stand on its own. But if you're not getting that level of claims, you probably want to look at a multi-year average. The other thing to keep in mind here too is that if there's a change in the product mix, you may want to exclude certain years. So for instance, if 2005 to 2007 was a 3-year warranty and 2008 forward is a 5-year warranty, first of all, you need to make an adjustment to your development pattern, but you'd also want to really look at 2008 to 2011 here, since it's not really apples to apples. So I talked a little bit about credibility. Credibility is an actuarial term and there's all kinds of math behind it, but just generally, in terms of an example, credibility is just how credible is the data underlying it. So the more observations you have, the more credible a data point is. If you think of just like a basketball example, if a guy goes up there and shoots 1 free throw and he makes it, if you give him 100% credibility, you'd essentially assume that he's always going to shoot his free throws at 100%. But in actuality, we know that's not true, because that's a small sample size. So we would assign less than 100% credibility to that. So that's essentially what things that you can do here as well. Is you can use different credibility weights to say, okay, I think the most recent year is most credible, and then basically assign weights to each historical year. The other thing I mentioned, trends, again, these to be changes in inflation, technology, anything like that that would cause results to be different over time. Generally what we see is, the severity trend kind of hovers around inflation, and the frequency trend, typically we see that going down over time. Of course, there's always, if there's a defect or some type of issue that, there can be an increase in frequency, but from kind of a global perspective, we see that frequency coming down. Products tend to be made better now. There's, a better process to identify issues and resolve them before, too much product gets out in the field. So again, this is just a trending example here. So, if you look at just this Senkit column here with the historical cost per unit, you see that that looks like it's going up over time, but it's really going up over time due to inflation. So if we adjust for 3% each year, you can see that those end up coming out to the exact same number. And so then when you're selecting a cost per unit, you'd be looking really at this on-level number that's already adjusted for inflation. So if you try to make a selection off the historical CPU, you probably end up with too low of an estimate. So one thing that comes up pretty often is using a range versus a point estimate. And this is something, again, that we've seen people go both ways. We have some clients that ask us to help them really just with a point estimate. That's really kind of the expected or mean outcome. Other people will use a range, and there's all kinds of accounting language surrounding that in terms of, if the low and high are most likely, you're supposed to book to the low. But, people have different philosophies, different accountants, different auditors interpret things slightly differently. So we've seen people treat things differently. But, just to kind of point out that, this is kind of a common discussion that we would have with clients, especially if there's a significant change in the product. If there's a new EPA requirement, for instance, for your engines or something like that, there may be a lot more uncertainty, so it may make more sense to use a range rather than a point estimate. So there's different reasons for using ranges or point estimates. One other thing that we commonly see people struggle with is this concept of a steady state. And so what a steady state is saying that essentially, growth is relatively flat, and as you're adding on new products, old products are falling off of warranty. So then at that point, your liability should really start to stabilize. A lot of people, I think, struggle with that in that, if you're growing, you would expect your liability to grow as well. It won't grow at the exact same rate. There's going to be a lag because it takes, especially if you have a multi-year warranty, there may be a little bit of a lag in terms of growth between the two, but just important to keep that in mind. I think I have an example here somewhere later to talk about that. And then the topic of warranty goodwill, I kind of hit on that a little bit earlier in terms of the effect of consumer behavior on warranty claims. Again, it's not really truly a failure rate. There's a lot of times when people will cover warranty claims out of the warranty period or outside the terms and conditions. This is very, very common. I think every single client we look at has some type of warranty goodwill. One thing that I will say is that it's very important to track this. I think if maybe you pull one thing out of the whole part of my presentation here, I think that's a crucial thing to do, to track what warranty goodwill claims are. And the reason for that, again, there's not clear accounting guidance on that, and William, you can, I guess, agree or disagree with that, but in terms of the clients we've worked with, we've seen some book a reserve for the warranty goodwill and others don't. Again, there's just not a lot of guidance specifically on this right now. But even if you kind of ignore the whole financial reporting impact, it's important to know how much you're spending on that. It's really discretionary spending, and you really want to be smart about how you allocate that budget. And you don't just you obviously don't want to just cover everything, but you also don't want to say no to clients. You want to be smart essentially about how you use that budget. But it's, as I said, it's a pretty common thing. It could be 5-10% of your total spend we see in warranty goodwill. One other thing to keep in mind is seasonality. If you have a seasonal business, it can cause results to fluctuate, and that doesn't mean necessarily that results are good or bad. It just means that there's seasonality. So if you're selling air conditioners, I would venture to guess that your units that you sell in the summer months tend to have a higher claims rate than those sold during the winter months. A lot of that has to do with the fact that you have some of the infant mortality claims right after they buy it, and then they end up having, for the duration of their warranty, they tend to have it in the summer more often than someone that buys it in the winter, just kind of how things would lie through high usage seasons. So there's definitely going to be fluctuation for things like that, so you should keep that in mind when making any type of projections or accruals, is that that cost per unit, the frequency, is going to be different from season to season. Another common issue is pipeline claims. So there's a lag, obviously, between when something occurs, when it's reported, recorded, and paid. Some of this will fall into calculations that you have to do for service contracts, especially if you have a captive and you're doing an unearned premium reserve. But generally, it's just important to be cognizant of this. Sometimes people will pull data, but it takes a week for claims to really get into the system. So if you do have a lag there, you want to make an adjustment so you don't, again, make a projection that's too low really just because the data is missing. Other things to consider when making any type of estimates for warranty, the entitlements of the contract, obviously the coverage length, any type of overlap with the extended warranty, that's something, or service contract. I mean, it's important to know from both a warranty standpoint and from the service contract standpoint in terms of what kind of overlap there is. Obviously, any changes in the coverage, changes in claims handling is a big deal, especially in warranties and service contracts. The call center is crucial. So you wouldn't believe some of the things we've seen, that a lot of times the claims are really driven by the call center rather than the actual failure of the product. If the call center is not incentivized correctly, or you don't have control of the call center for your product, we've seen people run into issues there where costs have kind of gotten out of control. So all important things to keep in mind when making any type of estimate. So we have a little quiz here again just to kind of break things up. So a steady state is achieved when, I won't read all these off for you. I'll give you just a couple seconds here and I'll flip to the answer. And it's really number 3 here, when the amount of experience surpasses the length of the warranty. So, that's really kind of the easiest rule of thumb to use is, if you have a 3-year warranty, you're really kind of in a steady state after 3 years. So let's start to get into some of the warranty versus extended warranty discussion. So the manufacturer's warranty is obviously the component of the product's cost, but an extended warranty is a separate contract that goes above and beyond manufacturer's warranty. Sometimes it'll even include coverages that aren't in the manufacturer's warranty. And so, the key thing here is that the revenue has to be recognized ratably over the life of the contract. And William talked a little bit about that earlier, but we'll go through some actual numbers examples here as well. And it's just a little bit more background on the extended warranties. So as I mentioned, especially for the extended warranties, we have bold and underlined there at the bottom, that revenue should be recognized over the contract period in proportion to the cost incurred in performing services under the contract. So, if you have a 1 year or less service contract, usually you can just do it pro rata. There's not really a big, there's not going to really be significant changes or misstatements due to not recognizing it pro rata. If you really wanted to be accurate, I guess you could. But this is really most important for those multi-year service contracts. So just to go through an example here of how you would do that. So let's say that you sold some service contracts, and just if you look at the lower left-hand portion here with the different losses, we'll see, kind of how the losses relate to the premium. So if you sold a product for $400 and you earned it pro rata over 4 quarters or 4 years or whatever this may be, you can see that your loss ratio basically fluctuates significantly from quarter to quarter or year to year in terms of how the losses actually emerge, because we'll see here that the losses don't emerge pro rata. They don't really emerge until the last quarter here. So what we do is we actually earn the premium or revenue. I'm using premium and revenue interchangeably here. And essentially earn the premium at the same rate as losses so that our loss ratio is consistent. So what happened here, and one of the big reasons this is done, there have been some pretty high profile issues where people were not earning the revenue or premium correctly for their service contracts. What can happen, you can imagine, and if we focus on this first case where they were earning it pro rata, let's say that this is a 5-year warranty, and you start selling it for the first time. After the first year, you see that it's a 50% loss ratio. That's great. That means we're making basically 50% profit. So let's keep pushing this. Sell more, sell more, sell more. You get to the second year, and you see that the loss ratio is even lower, so you're making even more money. So you start to get more excited. You incentivize the salesman even more with higher commissions, et cetera, et cetera. And then let's say that you get to the 5th year, and the losses in the contract are back-end loaded, and at that point you find out actually that all the contracts you sold were unprofitable. Well, you didn't find this out really until the 5th year, and so you've sold these contracts for 5 years. So it can basically lead to a mismatch. So your earnings will look great up front, but then once the losses start to come in, you'll just absolutely tank, and you will have written bad contracts for multiple years. So that's the reason that it's really important, especially for the service contracts, to earn that revenue correctly. I'm running short on time here, so I'm going to skip through this because it's really an insurance thing. So let's just go through an example here that kind of ties everything together of what William talked about in terms of some of the tables and the triangles that I've been talking about here as well. So let's go back to the first sales year. This is a hypothetical company, and so we have an opening balance of 0. The net accrual is going to be what we expect our cost to be for the products we sold in that year. So that'd be 10%, and 10% frequency, $100 severity for 1,000 widgets. So we would accrue a total of $10,000. We only paid $4,000, which we can see up in the triangle here. And so, we would estimate a closing balance using some type of loss development type approach, get $7,000. Our change in estimate, typically what's done there is that's backed into based on an estimate of the liability. So we'd back into that amount. So we can see that as $1,000 adjustment up, meaning that, claims are basically a little bit worse than what we would have expected. And so if we move to the second year here, we'll say, okay, well, we moved ahead a year, so we have another year's worth of information. So we have our opening balance, which is really a closing balance from the previous year. The amount that we accrued, we actually raised our claim frequency projection to 12% here. As I mentioned before, we saw that we thought that the claims were coming in a little bit higher than we expected. And again, we sold 1,000 widgets, so this year we're accruing $12,000. We subtract off our actual payments, so that would be the $4,200 here, plus another $2,000 that was paid, so the difference between the $6,000 and $4,000. So that's our total payments. Again, we'd make a projection of our closing balance for our liability and back into a change in estimate. So that's kind of how this would flow through from year to year. If we go ahead to the third year, again, kind of following the same process, we take the opening balance from the previous year, we make our accrual, we subtract out the payments that we make, and again, that all ties back to the loss triangle here. And again, we'd make another liability projection. And I should point out that this liability projection is really, that whole calculation we went through before with the triangles, where we're essentially completing this triangle, subtracting off, and then subtracting off the actual payments to date. So this would be the amount that you'd pay for any product that's already been sold. Again, we go on to the fourth year, kind of same idea in terms of making a projection. But I mean, I think a key thing to point out here is we've reached our steady state. So I talked about that before, that our opening balance was $13,400. We accrued $12,000 and we paid out $12,000. So our closing balance is actually flat. So you can see it didn't change over the year period. And that's just because I assumed here that this was just a 3-year warranty. So, this old product's falling off and you're adding on new product, and you're at that point in a steady state. So I'll skip through kind of our quiz here because we're running low on time. I want to give you guys a couple minutes for questions. So just kind of reviewing our objectives. We identified and defined some of the elements of warranty finance. William did a good job outlining that. We talked a little bit about the difference between warranties and extended warranties and some of the nuances in terms of how those are accounted for in the financials. We talked about a loss triangle and how that's used. I know some people don't use loss triangles. Some people use other techniques. What we've found is that loss triangles really are the best approach to reserving, to determining an accrual, to come up with that earnings pattern that's used for the service contracts. That's really what we use. That's what all the insurance companies that you guys work with use as well. We talked about several different accounting standards that are directed at warranties. And then we also talked about accruals and liabilities and what that terminology actually means as well. So with that, I'd like to open it up to questions to see if anyone has anything that they'd like to ask of myself or William. We'd be happy to answer them for you.
Michael, a few questions came my way,
okay.
And I'll read them out to you. One is when you have an overlap for the product being on warranty and under an active service contract, would you attribute the cost of the support to the warranty reserve or exclude it and charge the cost of the service contract revenue?
Well, I mean, to me, it would really depend on what the claim fell under. I mean, usually the manufacturer's warranty will supersede the extended warranty unless it's for some term or condition that's only covered under the extended warranty. So I think it really depends on where it falls in under the contract. But typically the manufacturer's warranty would apply first and then the service contract.
Just to add, this is William, we used to have we would apply this, the attach rate of the contracts to split those to some extent, because as Michael said, yeah, I mean, if you can see that maybe you incurred more costs because you had more robust contract terms than your original warranty, you know, the product is under warranty, but it's also upgraded to a contract, and maybe your original warranty says we'll get out there in 2 days, but your contract says we'll take care of you 24/7 within 4 hours. Well, obviously you've incurred some more costs because it's under contract. If you can split that, that's great. But if not, you could maybe just use your attach rate of your install base. So say on the average, most of the products you sell, 75% attach a contract, 25% don't. You could split the costs, you know, kind of in that ratio. So there's a couple options for you.
Okay. Good insight. One other question that we got here was, you know, in terms of how the warranty reserve is calculated, what do we see as the most often used methodology? You know, like I said, we rely on loss triangulation to do that. I know not everyone does that. What I see most often people use is some type of metric of number of claims in a calendar year divided by sales. That's typically not the best approach. That can be kind of a rule of thumb check, but if there's any type of growth in the company, that calculation will be incorrect, really. The best way to look at it is really on a sales or manufacturer basis and look at how that specific year is performing and project that forward. It's just, you know, doing that calculation on a calendar year basis is just not, you know, it's just not appropriate if there's any type of growth over time. And then also if, you know, you don't have enough experience actually to be through the whole warranty period yet in your historical data. I think the other thing that I see as well too is the kind of straight line projection. You know, William talked about that bathtub curve, which is much more realistic than just assuming that the claims occur evenly over the warranty period. I know, William, do you have any insight into that as to kind of how you've seen that done in terms of making the projections?
Yeah, thanks, Mike. It's obviously, as you said, you can't just look backwards in the rearview mirror. You have to look ahead and estimate. So we're, you know, modeling what the future looks like. You know, what the new products look like. Maybe they have some changes over the old ones. They'd either decrease or increase maybe their warranty liability, and modeling that. And then we're always trying to adjust as we do find out, you know, what the current state is or actual. But we're always using modeling to project. Yes. Okay.
Yeah, great. So I think we've run out of time here. So we'll wrap up. I just want to say, you know, thank you to everyone that joined us for the session. We did record the session, so you know, you'll be able to access that as well. And you know, I'd like to remind you guys of the GWSCA conference that'll be happening later this year in Chicago. So please sign up and register. It's always a fun time. I'm actually from Chicago, so we'll take some people out while we're here. So hopefully you guys can come out and make it. And we'll also be repeating the session, as I think Terry mentioned at the beginning. We'll be repeating the session at the conference there as well. So But in the meantime, feel free to reach out to William or I and ask us any questions. Thanks so much, everyone.